Let's go ahead and get started. Hi, everybody. Thank you so much for tuning in to another episode of the Sage Investor webinar. I am your host, Jen, joined by my partners, Maggie and Lana, and our special guest for today, Deborah Pritchard. We're going to get to know Deborah a little bit better shortly. But for those of you who don't know us, the Sage Investing Group, we are 3 women, and we are all Big 4 former auditors turned multifamily syndicators. So our mission is to empower other risk-averse investors to diversify their portfolio with cash flowing and appreciating assets like apartments. So if you're interested in learning more about what we do, you can go to our website and set up a call with me. Our website is sageinvestinggroup.com. Now, let's go ahead and get started. Today, I am very, very pleased and excited to have Deborah Pritchard, who is a partner at MRM CPAs, join us as our special guest. She's currently based in Frisco, Texas. Deborah has been providing tax planning and preparation for individuals, partnerships, and corporations since 2000. Her expertise includes a wide range of tax issues and includes real estate partnerships, nonprofits, and even international taxation. She actually lived in Canada, the UK, and the Netherlands. So through actively participating in multiple real estate syndications, right now, last I heard, it was 6 and counting. Deborah has developed specific expertise in the key tax considerations for participants in these opportunities. So Deborah is also my personal and the Sage Investing Group's trustee CPA. With the tax season right around the corner, I thought that she would be just a great person to invite onto a webinar to speak about the K-1 and the tax reporting specifically for multifamily syndicators or investors. And I know many of us here are just dying to understand the schedules that we get in our mailbox every year. And if you're somebody like me, you might even try to recalculate it and see if the numbers are done correctly, but it's confusing. So that's why we're here, why we have Deborah here today to kind of go through that with us. So today's agenda, here are the key questions that we're going to make sure we cover. I'm going to go through my questions first, and then we're going to open up the floor for questions at the end. You can either raise your hand and unmute yourself to speak, or you can just type it into the chat box with your questions, like during the course of the webinar, and we will address them at the end as well. I hope as investors, you guys are going to find this valuable and you're going to walk away today just being able to read and understand the K-1s and just better prepare for the upcoming tax season. So without further ado, welcome, Deborah. Thank you so much for spending time with us today. We are really excited to have you here. Now, before we dive in, can you tell me if I missed anything in the introduction and if there's something else you would like to add or tell our audience about yourself?
No, well, I can't tell you that I love doing taxes. If I didn't love my tax job, I would have been a real estate professional years ago. So I did start investing in multifamily in 2008, and I'm actually in 11 deals. I had 5 deals sell in 2021. And we're still actively deploying earnings from those deals. So
That's
some
awesome.
did better than others. Some did really well. So
yeah,
2021, I think prices were very high.
Mm-hmm. Yeah, we've had 2 investments sell in from 2019 sell in 2021. And like you said, some are good, some are bad. So, I think the key here is to really diversify and have multiple deals in your portfolio and not just count on one deal to do the trick.
Right.
Yeah, all kind of balance each other out at the end.
They do.
Yeah. All right, well, let's go ahead and get started. Let's start off with a pretty straightforward question so that no investor is left behind. Can you just tell us what is this Schedule K-1?
So can I share my screen? Can I bring up K-1?
Sure, definitely. Let me stop screen sharing and let you take over.
Okay, and so screen share. Okay, I told you I've got all these screens. I've just got to find what I want to share now.
All right. Yeah, you told me you have 4 monitors up, so.
Yeah, and so what I want to bring up is
Me.
this, because I need to get to this. Okay, so can you all see that?
Right now, I see your desktop with lots of files.
Okay, so how do I open something up on my desktop?
Oh, I see. Oh, let me see. Can you pull it over? Can you pull it from one screen to this one? I don't know if you're able to drag it into this desktop.
Yeah, so I don't, yeah, you are screen sharing. I want to, maybe if I bring it to this.
Move to,
Can you see it now?
yes, I can.
Okay, so now you can see it. Okay. Okay, so this is actually my K-1. So I'm very happy to share it. All I did was remove like the names of the deals, but this is my actual K-1. And so what is a K-1? This is what you're going to get. And basically, when we are in a partnership, we all own a percentage in that partnership. And what the K-1 is showing us is what our percentage of the profits and the losses, gains when we have them, debt allocation. It just shows us what our percentage of all those items is.
Okay.
It's the way a partnership reports income to all of its partners.
Okay, got it. All right, so every investor who invests in like a private placement would get a K-1, essentially.
And yeah, any partner that invests in a partnership,
Okay.
is going to get a K-1.
Okay.
Sometimes these deals are set up where there's a partnership and a tenant in common. The tenants in common are not going to get a K-1 because they've actually, when we have tenants in commons, we've elected out of what we call subchapter K. The partnership will still get K-1s, but the tenants are not going to get a K-1.
Okay, got it. Okay. Well, so now that you have this K-1 up and you can explain what the schedule is about, our second question is, most investors, we see what you have here, but I guess we want to understand it. So would you be able to walk us through each section, just explain what each of these numbers mean and how they were calculated, if that's even possible to tell us?
Absolutely.
Okay.
So, when we are getting our information from all of you, we're always asking, if you're an LLC. So I'm going to take you down to part 2 and I'm going to say F, the partner's name, address, city, state. So if you're an LLC can file as a single member, it can file as a partnership, or it can be an S corporation. And so I-1, we ask you what type of an entity is this partner? This happens to be, this was originally in an IRA. We're going to show you because we actually transferred it out of that IRA. But it was originally in an IRA. Well, if you're an LLC, that's going to say LLC. And this actually is from 2018. 2018. In 2019, you're going, the next one I'm going to show you, it also changed that we have to put in what we call all of that disregarded entity information. So if you're an LLC and you're a single member, what your K-1 is going to show in F, it's going to be your personal name and address. And then down in this I-1 and 2, it's going to say LLC. It's going to say, is this a disregarded entity? And it's going to have the name of your LLC there. So in box F is going to be your personal name. And that's why when you invest, if it was like Deborah Pritchard LLC, that's going to be down in the I section. My personal name, Deborah Pritchard, would be up in the F section. So that changed. The IRS changed those rules for 2019 and going forward. The next thing is going to be like your profit and loss sharing rate. So those are based on, this is the first year of a deal. So usually the beginning is 0. And the reason the difference in the capital and the profit and loss is because, this was like an 80-20 deal. And so your profit and loss is 80% of 100. And my capital, though, all of the limited partners put all the capital in. So we own 100% of the capital at this point. The
Okay.
next.
Wait,
okay.
so then the 12%, so the 12.01%, that is like whatever amount that you put in. Sorry, so this is 12% of the total equity.
No, that 12% is what I'm going to get allocated for the profits and losses.
Okay,
The profits and losses are going to get divided 80-20.
got it, right.
And
Okay,
so if the profit and loss is usually less, unless you're getting allocated 100% of the deal, right?
mm-hmm.
So the profit and loss is the 80% of the losses we're going to get allocated, or gains. The
Right.
same, we get allocated gains as well on those ratios. And capital is, I owned 15% of the capital, and that is 15% of the total that was contributed to the
Got
deal.
it. All right, so then profit and loss is going to be based on the split in that deal. So if
Yes.
it's an 80-20 split, then whatever so you can typically, if it's 80-20 split, then 12% is kind of your share of the profit loss because of the 80-20 split between the limited partners and the general partners. And then for the capital, there's no split. You own like 100% of the capital that you put in. So that's why it's 15%.
Right.
Yeah. And then typically you can get that number, right? The allocation, you can get it from the operator, whoever
Right.
the sponsor is, you can ask them that question. Or you can kind of calculate yourself, right? If you know how much equity was raised, and then of course, you know how much you put into it. So
Right.
then, yeah, you take what you put into it divided by the total equity raised for that deal, and then you multiply it by the, 80% if it's an 80-20 split, or 70% if it's a 70-30 split. Yeah.
And we've occasionally had questions about those numbers. And so the thing that you need to verify with the operator is how much capital was raised. Because we've had it where they've actually, in the end, raised more capital than they said they were going to. And so when somebody's done their own calculating, those percentages haven't been what they thought they were, but that's because there was more capital raised. So everybody's percentage of ownership was diluted.
Right.
So,
okay, so it should pretty much stay the same unless there may be like a capital call, right?
Right.
And they raise more capital. So
yeah, what's going to happen is the capital number is going to change, right? Because as we start allocating profits and losses and gains and things, but the P&L is not going to change. What we allocate for profits is not going to change. And you'll see that in the next K-1.
All right.
The other thing that so in a partnership we get allocated our portion of the non-recourse debt, the qualified non-recourse financing, and if there is any recourse. Usually in most of these apartment deals, it's qualified non-recourse financing. And what this does is it's actually a very important number, because in a partnership, I can add that $581,284. I can add that to what I call my basis. And so my basis is increased by the amount of that debt. And that's what allows us to take losses, because you can see from here, my capital contribution was $225,000. Well, in the first year, I got allocated losses, mostly due to depreciation, of $148,000. It took my basis down to $76,745. If the next year, they gave me $100,000 distribution, I would have negative basis just going on this Schedule L, but I can add that qualified non-recourse financing, that $581,000 to my basis. And so I wouldn't have to pay tax, because generally, if your ending capital account is negative, that's a taxable event. But it's not in a partnership, because we're allowed to add that qualified non-recourse financing. And so I wouldn't have a taxable event until my, cash account was negative, 600,000 and something.
Okay, so great. Okay, no, that's great. And then for the, I guess, where would investors be able to verify the figures in Section K, the non-recourse and the qualified non-recourse financing figures?
Yeah, because the qualified non-recourse financing is going to be the note. And the way the investors, this is why you probably want to see the financials and you want a balance sheet so you can see what that note is. And basically you're taking your 12% of the note, and that's what's getting allocated to you for qualified non-recourse financing.
Okay, got it.
It gets allocated in the 80-20 split, or whatever the split of the deal is, 75-25. It gets allocated in the same manner.
Got it. All right, that makes it really clear. And then for the non-recourse, where's that number from?
The non-recourse is usually things like accounts payable. Non-recourse is going to be anything else that's sitting in the liability section of the tax return or the financials. So, because it's only non-recourse means they can't come after anybody outside of the partnership. So it's just like accounts payable.
Okay,
maybe,
got it.
yeah, a
So
temporary.
the allocation of the accounts payable, or just the accounts payable, or all the liabilities?
No, it's all the liabilities. So maybe
Okay.
it might be accrued taxes, property taxes, accrued insurance, whatever those accrued expenses are as well.
Got it. Okay,
That's what sits in non-recourse.
got
But
it.
that
All
doesn't
right.
really give us basis, the qualified non-recourse financing gives us basis.
Okay, got it. All right. And then you said that you can add the non-recourse, the qualified non-recourse financing number to your ending capital account to increase your basis.
Right. So my basis at the end of 2018, let me just add these numbers.
Mhm.
Get my calculator. So my basis on my basis schedule at the end of 2018 would have been $658,029. It's taking the $581,284
Mhm.
and adding the $76,745.
Got it. Okay, that's clear. And then like the 148 current year increase decrease. So that came from the financials as well.
No, that actually is coming from the part 3 of the K-1.
Okay.
Okay, so it's taking what is in box 2 of the net rental real estate, the loss of 141,662. Now that number is coming from, if you have the tax return, which should really balance to the income statement that you get, but often the income statements that you're sending out to investors are going to have at the end of the income, you have your net operating income, and then you might have capital expenses and things like that on your income statement. Well, those aren't going to show up. The capital expenses are probably going to get moved to the balance sheet and depreciated. And that's how they'll make their way over to the income statement. So this, if you send out Form 8825, where all of the, if you're looking through the tax return, Form 8825 is where this numbers gets generated from. It takes that loss on the 8825 times your percentage.
Okay, loss times the percentage. In your case, 12%, and then times 80% again for that 80-20 split.
Right.
Got
Right.
it. Okay.
And that number is comprised of, it starts off with your gross revenue. Then you're taking off your lost leases, loss to lease, vacancy and stuff. So it ends up, you get net revenue, less all of your expenses. That's depreciation, it's interest, it's payroll, it's, contract services, which might be pest control, maintenance, any repairs that we aren't capitalizing. It's asset management fees. It's, management fees as well from the property management companies. All of those combined to make the loss in box 2. It is not just depreciation, but depreciation will be the biggest component of that loss.
Okay. And as an investor, being an investor yourself, you have, you can request the that syndication entity's tax return from the sponsor, so you can verify all this.
Yes, yeah, and I think everybody should, just so that they have an idea, because we have actually, occasionally, it's only happened on a rare occasion where, the percentages that we were given on a spreadsheet were incorrect, and how the investor, like maybe he was told something else, maybe they have a different spreadsheet, it didn't get updated, or we used the wrong one. So usually the sponsors will be verifying all of the, the percentages for each investor, but it's always good for investors to verify their percentages as well.
Right. Yeah.
And to verify the information that we have on the K-1, like your name and, if it was an IRA investment or a trust investment, make sure that's what's reflected on the K-1 and it's not sitting in your personal name. So as soon as you get your K-1s, you should verify that information because that's easy for us to change. It's not so easy after September 15th to change any of that.
Right.
So, we always encourage everyone to actually verify all that information, personal information, as soon as they get their K-1. So,
All
yeah,
right.
usually in a real estate partnership, everything's going to be reported in box 2. Occasionally, you might see something in box 1. And that's usually only going to happen if there's been a fire, or a flood or some kind of an insurance claim at the property.
Okay.
So that's usually you're not going to have anything in box 1. But if you do get something in box 1, I'd ask your sponsor to explain what it is.
Right. Okay. Great. Thank you. That helped.
Now, you're going to other deductions, K, this was a new thing that came out in 2018. That was the limit on interest, the ability to deduct all interest in the partnership. And so it's flowing through to each people individually. And so whether they can use that depends on what their personal tax situation is like. So there's an election that we can make to so that our interest is not limited, that we can deduct it all within the partnership. But it's something that we talk to each of the sponsors about to determine whether they want to make it, because it's what we call the 163J election, and it is an irrevocable election. And so irrevocable elections are not something that we would make without you telling us to make it, because it's irrevocable. But what it does is it takes your 27.5-year building and you have to depreciate it over 30 years. So for that difference, that the 2.5 years versus being able to deduct all of your business interest, usually we would make that election. These people decided not to make that election. So as I said, we asked the sponsors, and I have very few sponsors that have not made the election, because it just is, I'm going to close this window.
All right. And this is the election. I'm sorry. So just to make sure I understand, this is the election to take advantage of the bonus depreciation.
No, this is a limitation on business interest.
Okay.
Right. So if you've got a big loan and it's an interest only loan for 3 years or whatever, you're going to have a lot of interest. And the IRS came in and they limited our ability to deduct it all in 2018 with the Tax Cuts and Jobs Act. But we do have the ability to make an election called a 163J election that will allow us to deduct all of our business interest. But it takes the building, it increases the building's depreciation to 30 years instead of 27. So, it just means your adjusted basis will be higher because we've only been depreciating it, over 30 years. But we can still take 100% bonus on anything under 20. It doesn't affect those assets.
Mm-hmm. Okay, got it. So that's for the interest.
Yes. And I would rather have this number in box 13 up in box 2, because 13 is based on my personal tax situation. Box 2 is not.
Mm-hmm.
So I want the deductions to flow through the partnership anytime I can.
Okay.
And then, that's, all of these other deductions. And so box 20 is other information.
Mm-hmm.
And all of that gets used for what we call the qualified business income deduction that also came in 2000, the 2017 Tax Cuts and Jobs Act. So these numbers here are going to be things like, if you go to the supplemental part of the K-1, it's going to tell you what that is, the qualified business income. And depending on where you are in the, what we would call depending on where your adjusted gross income on your personal return, this all flows to your personal return. They use these different numbers to determine what your deduction could possibly be. If you got negative income, you're not going to get a deduction. So all these other numbers don't really matter because it's negative income. You can only get the qualified business income deduction if you actually have income. So if there's no income, they're not going to, there's no deduction. So this K-1 is not showing any income. It's showing a loss of $141,662. Now, the other thing I should have pointed out is in G, box G over in part 2, I'm a limited partner. I am not an active partner in this deal. That means I'm not a GP. I don't have any job in there. I'm just put my money in and I'm looking to get my investment, my distributions and my gain at the end. So this loss for me in 2018 was what I would call suspended. I could not use that loss against my ordinary income. It just sat there for the following year. And it's sitting there until I actually have passive income, because this is considered a passive loss for me. It's a passive investment. So we actually have 3 types of income, right? We have ordinary income, we have what we call portfolio income, and then we have passive income. And portfolio income is usually what we're earning on our stocks, dividends, interest. Royalties can be considered passive or portfolio, depending if it's usually considered passive income, a royalty. And then real estate, all of this stuff in real estate. If I had single family rentals, multifamily, it's all considered passive income. Unless you're what we call a real estate professional, but we can talk about that later. So this is passive income for me. My loss got suspended, and I'm going to pull over now my other K-1. And this takes us to 2021. It's going to be, it's a final K-1. The deal actually sold in mid-2021. So if you want to make sure that the final K-1 is checked, because I want my passive losses released. So this, I still, I got allocated 141,000 in losses again in box 2. But let's look at box at, part, this is still part 2, but section G, you can see there's much more information in here. So it's asking H2, if the partner is a disregarded entity, enter the partner here. So that's where I would put your LLC name and the EIN number for your LLC. They would be sitting in H2. And your personal name would still be sitting in box F. If you're a partnership, your LLC is a partnership, well, the partnership's name is going to be in box F and nothing will be in H2, because a disregarded entity is only a single member LLC, where you are the only member and it is just getting reported on your personal 1040.
Right. So H2 is only for single member LLCs. If you're investing as an individual, jointly with your spouse, or under like a separate LLC, like a separate entity that's not a single member, then you would not have to fill out part H2.
That is right.
Right.
And remember, I told you we transferred this out of an IRA and we put it into a trust. Right. So this partner is now a trust. And so you can do that kind of stuff.
Yeah, so, you can change the entity that you're investing and to something different during the course of the investment.
It is possible, but the thing is that, we paid to do this, right? Because there's a cost to doing, because in the year that we did this, which was not 2021, we got two K-1s, a final for that original IRA and a new one for the trust. So they have to issue two K-1s in the year that you actually transfer that interest.
Mm-hmm.
It's a lot easier if you do it at the beginning or the end of a year, because otherwise they have to bifurcate the income between, the time that you had the old one and you transferred it into the new one. So all of that increases the cost of doing the tax return. So this actual particular sponsor charges the individual members to have these changes made.
Right. How much does it typically cost to make that change, Deborah?
It varies. I've got a couple of sponsors that are charging $750, and I have some sponsors that charge $150. So,
okay.
Yeah. So they leave that up to you. They tell you what the charge is, and then you decide if you're going to, if you want to actually pay it and have it transferred. Because it's a lot easier to do this before you actually get into the deals. If you think you're going to put it in an LLC or a trust, you might want to visit with your attorneys and your tax advisors before you start investing, because it's a lot easier to have it done at the front, in the beginning.
Right. Oh, and Deborah, sorry to interrupt. Kim has a question which is relevant, so let me just ask it now while you kind of just mentioned this. You mentioned about the ordinary portfolio and passive income, and he's wondering about capital gain. Where do they fall in these incomes?
Capital gains are usually portfolio income, but remember on this we're getting 1231 gains. So this 1231 gain is going to offset my passive losses, because it's being generated from a passive investment, and it's a 1231 gain. So it's not really, it's not, even though it gets treated at capital gains tax rates, it's not really like a stock investment capital gain. Okay. So, my ending percentages here are 0 because the deal sold this year. At the beginning of the year, my capital account was negative, but I remember I had qualified non-recourse to give me positive capital. I got allocated for income, that 528,773. Remember that all that comes from all these numbers here in part 3. So it's the negative $141,020. It is the $669,583. That's the gain that's my portion of the gain. Other income, these guys actually, so that 11B other income, their property management company applied for the PPP loans, payroll protection. And so they were allocated PPP money. And so then they turned around and allocated it based on payroll percentages amongst all of the companies that they had under management. So my portion of the PPP money that we got was $384. And that PPP money is non-taxable, but it gave me basis.
All right, so sorry, the number 597,604 under the qualified non-recourse financing, it's a sum of all the numbers in.
No, the 528,773, the current year net income. Yeah,
got it.
597, as you see, it's gone. I have 0. I have nothing in that column to give me any basis.
Got it. Okay.
528 is coming from these numbers. So it's going to take the $141,020 loss. It's going to take the gain of $669,583, add the $384. And the other thing that affects my basis is this non-deductible expenses, $174. So all of those numbers should add up to the 528,773.
Got it. Okay.
The reason I didn't add 9C in there is of this gain, the 669,583. This is what they call unrecaptured section 1250 gain. It's recaptured depreciation right. This is only on the building. There's no If there was recapture on any of the other assets, which people always worry about, that would be in box 1. But when you sell an asset and you allocate the purchase price, you only have recapture if there is a gain. And often on that 1245, it's not going to be a gain. Most of this gain went to the building and the land, or all of it did. And so we have just $33,220 that would get taxed at 25%, the 1250, but that depends on what else is coming through on your personal tax return. So that number may or may not affect you.
Well, in which situation would it not affect you? But maybe if it's offset by other passive losses from another investment,
Yes,
would that help?
Because for me, I didn't pay any tax on this because I have lost all my losses came through to offset this total gain.
Mm-hmm.
The total gain of $669,000.
Mm-hmm.
Because all of my passive losses. So I was in 11 deals before my 5 deals sold. All of them generated losses, as you can see, but 5 of them generated gains. But my losses from the old ones and the new ones that I got into were enough to offset this entire gain. So there was no tax paid on that $669,000. So that's my gain, but up here, this is box 16 is a new box as well. We have also, not only do we have K1s in 2021, we have K2s and K3s. So if your syndication has any foreign investors, there will be K2s and K3s that will need to be issued. If it's got, dividends from a foreign country and stuff, most real estate partnerships aren't going to have that, but you might be in an investment partnership where you're going to get a K2 and a K3 because it's got foreign tax credits. So box 16 is new. 18 is basically 18 is non-deductible expenses. These were penalties. They were issued some kind of penalty that's really not deductible, and so it sits in box 18, and it means it reduces my basis, but the partnership couldn't deduct it. So we don't want them we don't want them paying penalties for whatever reason. So the distributions that I got in 2021 added up to this $475,487, of which $225,000 of that was my original investment.
Mm. So that's all from the sale. So it's from the sales and plus the cash distribution during the course of 2021.
Yes, all these distributions are specific to 2021. Mm-hmm. Prior to 2020, in the end, I in the total deal, I think we got $488,000 in distributions. So the distributions prior to that, the 13,000 or whatever, were in prior years.
Okay, got it.
475 of this came in the year of sale. So
wow. Okay. So it sounds like during the course of the investment, there wasn't really a lot of distributions during the life of it, but then at the end, it's when you were able to realize a lot of those that gain from the investment.
Yeah. The first 2 years, there were very little distributions. A lot more in the third year, and then this is the fourth. 3.5 years it sold. So most of these distributions came in the first half of 2021.
Got it. Well, that's a nice chunk of distribution right there.
It is, and as you see, so on a typical K1, because I think the other one is still here. This one, what you always want to see as an investor in a K1 is I want a big loss in box 2, but I want positive numbers. So you see the first year I didn't get a distribution. I want a positive number in box 19. Now, it really depends on when this, this was bought in the latter part of the year. So it doesn't matter what time we buy the asset, we can take 100% bonus depreciation. So we could buy it December 30th. And so my K1, it doesn't reflect when I really bought this, when it began. So box 1 was what you would expect, a big loss. And box 19, no distributions, but I didn't pull up the other K1s, but in the other 2 years, there were distributions. But you want a big loss in box 2, and you want a big number, you want a number in 19 to be positive.
Right.
Because what it means is you're showing a loss, but there's cash flow and you're getting distributions from cash flow, because cash flow is different than net income.
Right.
And most of that is due to depreciation. It's a paper deduction. It's what takes my loss up to this big number in box 2, but allows me to get distributions from the cash flow.
Okay. So I just did a quick calculation. It looks like the return on this was like well over 111%.
It was, yeah. I think it was close to like 113%.
Yeah, including the other distribution you received in other years.
Yes. Yeah.
Great. Congrats.
And so the other information here, we actually convinced these people to do that election. So you can see in box 13, there's no, because in the other years, because they hadn't planned on selling it when they did. So going forward, we wanted, so we talked them through how that election works. And so this actually allowed us to deduct all that interest. But yeah, it's, there's all of this information is just going through what we've already talked about. Like, this is how it gets to the 528,773. So you should always be able to see that calculation to find out what numbers are included to actually figure out how they got that 528,000. And if you can't do that, you might ask your sponsor, because you should be able to verify this number. And if there's ever something in other increase or decrease, you want to make sure there's an explanation that tells you why there's an other increase or decrease. If we're going to be transferring an interest, that will be in there, but it will be in the explanations. If somebody transfers their interest mid-year, if they want to put it in an LLC or they want to put it in a trust, that's where that increase or decrease. So the capital that was on the ending K1 will be the beginning capital on the new K1.
Okay.
You should verify those numbers, make sure they match when you if you decide to transfer your interest midway through a deal.
Okay. And just since we're on this section and Aaliyah has a question relevant to it, she asked for the recapture section 9C. Does that number match exactly the original depreciation that was filed originally or added up each year? Wondering if you can actually see penny for penny it matching over the years.
Right, that number actually comes from if you look at the depreciation, that's the depreciation taken on the building. And you should be able to,
building.
so if you're getting a copy of the tax return, you should be able to add up the depreciation, because that is only the depreciation on the building. It does not include any of the other depreciation, like on the 5-year assets, the 15-year assets. That is only the building. There was no recapture here on any of the other assets.
Is that the case for most syndications where like the other assets other than the building do not get recaptured, or just in this particular case?
No, I mean, basically it's how you sell, how the sale price gets allocated to the assets.
Mm-hmm. Okay.
And so if you've held something for 5 years, typically we're not going to allocate any of the purchase price to any of the 5-year assets, because they're fully depreciated anyways.
Mm-hmm.
And if you've got a stove that's 5 years old, have you made a gain on it? No. I mean, so it really depends on how the sales price gets allocated.
Got it. So for like in a syndication, just to clarify, like, if it was supposed to be held for maybe like 6 years, but then they sell it in year 2, then it hasn't, then, the asset other than the building has not been fully depreciated. So then that means some of the sales price might be allocated as recaptured to the other assets that are that were being categorized under the 5-year life.
Yeah, it's possible, right?
Mm-hmm.
For us, it's on a case-by-case basis. We look at it And, if you didn't go in there and replace every one of those refrigerator stoves, all the flooring and all those units, we're not going to allocate its proportionate share then, because they're still the old assets that you bought from somebody else.
Got it.
Can I ask that question a little bit more? Is that with the recapture, and you, in this case, you said it's the building specifically. So the only person who could kind of compare the apples to apples is probably the CPA who has the depreciation allocated into both the building and then in this case, the items or the other things that are depreciated, that there really isn't a way to go, there's that 33,220 that was in my 2018 depreciation for land. Here it is showing up now in 2021. There isn't a scale balancing, correct?
No, you should be able to get the depreciation schedule, and you should be able to take the depreciation that's been taken on the building to date, multiply it by your percentage, and it should be that 33,220.
Okay.
Yeah, that should all be in the depreciation schedule.
Thank you.
These are all my friends. Yeah, I mean, these numbers should all be verifiable by everyone if they have a copy of the tax return. But typically we're not, most syndicators, they don't give me copies of the tax return unless I ask for it. And for some, I've definitely asked for it.
All right. And then you were saying that, so that's the land, 9C is in the land. For all the other items, that if there is depreciation recapture, it would show up in which box?
One.
One.
Show up in box 1 as an ordinary. Yeah.
Okay. All right. So that box could be the depreciation recapture for other items. And also, if you said earlier there was a fire or flood and you have filed an insurance claim, something would appear in the box as well.
Yes. And as I said, we would put supplemental information on this, pages 2 and 4 to tell you what's sitting in box 1. And if it was depreciation recapture, I'd want to know. If there are insurance proceeds up there, I want to know as well, because any insurance, claim I've ever done, nobody's made money.
Mm-hmm.
They've had to fight to get the money to actually, be able to repair it to the state that it was in prior to the fire. So, yeah, I would ask for much more of an explanation. I mean, it doesn't mean you're going to get it, because I have a client that had a huge number in box 1, and we asked we wanted to see what it was. We wanted a copy of the tax return.
Mm-hmm.
They wouldn't provide that, and they just said it was insurance proceeds. And it was a huge number. And I'm like, so I said, they didn't repair anything, you still have the building. It's not a final K-1. And so they wouldn't give him an explanation.
Okay.
Which to me is not best practices for anyone.
Right. So Leah has a question about recapturing bonus. What about recapturing bonus depreciation if sold early?
It's the same thing. It all comes down to the allocation of the sale price.
Mm-hmm.
How we allocate that sales price. There's no recapture if there's no gain. And so, as we said, it's a case-by-case basis. We look at, what's happening. I mean, it's possible there might be recapture, if you sold it after 2 or 3 years, but we do look at it on a case-by-case basis.
Okay. All right. Well, thank you.
I know other CPAs that just take the sales price and they just allocate it on, based on percentages, what your 5-year assets were, the percentage of the total, and that's how they allocate it. But we know, even in the 2 years that some of these deals have been held, land has gone up substantially. So we're not going to just allocate 15% of the purchase price to land. So we look at it, we look at where the sale is, and try to allocate based on realistic figures.
All right. Thank you so much, Deborah. I think that's a lot of great information, and have a much better understanding of how this K-1 schedule works.
Mm-hmm.
And I know we have like 2 other questions. Maybe we can go through those really quickly. so that I know it's kind of tight on time now, but it's fine. We'll go through these questions. If you guys have to drop off for any reason, that's fine. We can send you the recording afterwards as well. So the other question I had was about like how, I know a lot of our audience would probably like to know how these Schedule K-1s affect their taxes. I know it's very different for each person depending on like what they do, the profession, the income, and what their investments are. But maybe we can just go through a few scenarios on very high level and see, get an idea of how that might impact them. I think you might have mentioned this briefly earlier, but for our first scenario, it's maybe for a W-2 professional who, just get the W-2 and they have stock investments. Will this passive loss from this K-1 help them in any way?
Not against their W-2 income, no. But they may have other passive income in that year. So this loss could possibly, if you're passive, could possibly offset some of that income. So for me, my husband and I are both, wage earners. We have ordinary income. We're passive investors. This doesn't help me at all against my ordinary income. But in 2021, I have it's not helping with my ordinary income, but it's offsetting this gain of $669,000. So as a passive investor, if you don't have any other passive income in the years where you're getting K-1s with losses, it's not going to affect your tax return. It's just going to be suspended and carried forward to the future until you do have passive income.
All right. And I know a lot of investors have this question about stock investments. So if they invest in stocks and they sell their stocks and they have gain from the stocks, can they use the passive losses from here to offset those stock gains?
No, because remember, those gains are portfolio income. These losses are passive losses, and passive losses can only offset passive income.
Right.
It cannot offset portfolio income.
All right.
If you're a passive investor, if you're an active investor, all this changes.
Right. We can talk about that a little bit more later. And then so for professionals, let's say they also have single family rentals, because that's a really common situation too for our investors, where they own a few rentals and they collect rental income. What about, how would that help in that situation?
That's all passive. So those would all help to offset each other. So if their rentals are showing income, these losses would help to offset that. Absolutely.
Okay.
Yeah, single family, multifamily, it's all real estate. It's all passive.
Right. And then what if when they sell those rentals and get that capital gain, like they make $100,000 off of the sale of the rental property?
It can be offset by these passive losses. Yes.
Yep. And what about flipping homes? Like if they flip homes and they make money from that?
Okay. Flipping homes is not passive income. It is ordinary income. It is a trade or business, and it's also subject to self-employment tax, and it cannot be offset by passive losses. So flipping homes is not the same as rental, because these are all rentals where we are gaining rental real estate income. If you're in a partnership and you're flipping homes, all of your income is going to show up in box one. And so that is not passive. That would be active income.
Okay. All right. And then I think we talked about this, professionals who invest in the syndications that you say you can use if they invest in syndications. Why don't you just kind of reiterate that one more time? So
those would be real estate professionals. And a real estate professional, there's two.
Oh, I mean like W-2 professionals. Sorry, Deborah. So W-2
professionals,
like you guys, like you and your husband who invest in syndications, when would these come in to be useful?
Whenever we sell. So so as I said, I had 5 deals that sold. I need all of these losses in box 2 to offset those gains. And so that's when so basically for me, we've been investing passively since 2008. And so within 2008, we've, bought and sold many properties in there. We paid $0 in tax because all of even though I couldn't use it on a regular basis, we were getting distributions. Distributions are not taxable. But anytime something would sell, I had all of these losses that would offset my gain. Where I'll get caught is when on my final K-1, when I've decided I'm not going to invest in real estate anymore. That's when I'll have to pay tax. But right now, I make sure that, if I get if we get distributions or one of my deals sells, we get it into another deal to get the depreciation to offset the gain.
Got it. Okay, so just keep on, I guess, pushing the tax liability into the future until you do not
Absolutely.
want to reinvest that money anymore.
Well, or until I die, right? And then my kids become the beneficiaries and they get a step up in basis.
Oh, that's a good strategy too. So there will be no taxation.
Yeah, death and taxes, right? So yeah.
Yes. All right. And then we talked about this briefly earlier. What about real estate professionals who meet the designation criteria for being a real estate professionals and they invest in these syndications?
Right. And so all of these losses are deductible by them because they're no longer considered passive. They're considered active, and they will offset W-2 income, portfolio income. They'll offset all income. It just acts as a regular loss.
Got it. So yeah, the real estate professionals essentially get the best tax benefits.
They do.
Yeah.
And that's why the IRS has more, you have to have a logbook, because you get such a tax benefit from it. You have to keep the logbook. It's got to be, so the firm has had 2 real estate professional audits, but we had logbooks to substantiate their hours, and there were no change audits. So we insist, that you have that logbook. We coach you. We've looked at it and said, is this sufficient? We'll say, well, maybe you need to add, it needs to be whoever you were visiting with. Just don't say that you were talking to an investor. Put that investor's name down. Because it's not going anywhere. It's just to show the IRS you were actually talking to somebody.
Right. In case you get audited, you need to show proof that how
And
you've spent your time.
Right. And the logbook is supposed to be contemporaneous, meaning, you're supposed to log it daily. Now they will let you go back. I mean, they're going to slap your hands and, make it up. But, and the reason they do that is because typically you're going to forget about some of the hours you were actually working. Because we've seen it with mileage logs. They'll let somebody go back and make a mileage log, and maybe they'd had 2,000 miles on their return, and they can only come up with 1,800. So it's usually why they'll let you do it, because you typically forget what you actually did.
Right.
If
it's
you're
hard. I can't remember what I did last week, so it's can't imagine having to go back a year's time.
Right.
Yeah. All right. Well, thank you so much. And then one last question, just for people who are potentially new or they started investing in syndications this year. What are some important things that these investors should expect or know about the K-1s so that they are prepared for the upcoming tax season? Maybe when do they expect to receive them and all that stuff?
Yeah, I mean, basically, I'm going to say March 15th, because that's usually the IRS doesn't even allow us to start electronically filing. The forms for these K-1s usually aren't ready until about February 15th. So usually we've got a month to get them all out. So we tell syndicators, we'll get them out by March 15th, but that's probably the earliest. And really if it's the first year, and somebody's trying to figure out how much tax they might, they'll still have a month to get this K-1 to their tax preparer to get it done and filed on time. But it's not this for me. This year it's going to affect my tax return because I've got a gain. But normally there's nothing in there that's going to affect my tax return. So I can figure out what my tax liability is in January, which I usually always do. Try and estimate how much tax I might or may not owe in April. But I'd say March 15th is when these are all going to start coming.
All right. And then I guess the latest, is there that's earliest, but in terms of, typically when's the latest that, you've seen them go out?
Oh, well, we see some that don't go out till September 15th.
Wow.
Because that's the final filing deadline. So they're not ones that we're doing, but we often won't get K-1s for some of our individuals until after September 15th, because they don't get done until the last minute. So it holds up some of our individual tax returns. We have to file them after September 15th.
Yeah. So I guess what tip would you give to investors investing in syndications? Because it seems like the K-1, it could come in before they have to file their taxes, or it could come in much after. So what's the best practice you would recommend for?
When you say come in after, like, I mean,
Like, yeah, I guess what I'm trying to get at is, do you recommend them filing extensions in? Just, you never know when it's going to come in, right? So would it be just best practice to try to just file an extension early, knowing that, you may not get it on time, to file your taxes on time?
To me, I would talk to your CPA, but to me, it never hurts to file an extension, because you can still file on time. But at least you filed an extension if for some reason your K-1 doesn't come in, or the name is incorrect and you want to get that changed before you file. For me, it never hurts to file an extension. But knowing, I mean, we try to get all of our individuals, if we've got all their K-1s filed by April 15th.
Okay. So it depends on the CPA, essentially.
Really
depends on them. So just talk to them.
Yeah.
Okay. Yeah. I think for me, I'd like to file the extension just so that I am not stressed, waiting for that K-1 to come in. I know I have more time to just calculate and prepare the taxes and wait for these to come in whenever they're ready. So that's kind of what I generally do.
Right.
Well, thank you so much. Do you have time, Deborah? I know we're like well over our time.
No.
Oh, okay. Thank you so much. So Leah we have several questions in our chat box. Leah asked, question on best practices. Do we provide 1099s NEC to general partners for their acquisition fees because they are considered income to them, or can we just put it on their K-1s?
Best practices to me is not on the K-1, it's sent a 1099. It's in the the acquisition fee is in the K-1, it's in box 2. I don't like putting it out as a guaranteed payment because we prefer to send a 1099. We think it's best practices that you should send anybody that got an acquisition fee a 1099. And that's we're doing that right now for many of our syndicators, generating 1099s for them. Now, a lot of times your property management company, if it got paid after you had your property management company, they should be sending you the 1099s.
All right, thank you. Leah, if you have any follow-up, let us know on that.
No, I think that answered it. Thank you.
Okay, great. So Bao asks, is there an expiration for how long you can carry forward the losses?
It's indefinite. Yeah.
Perfect. So even if you, okay, never mind.
It's not like,
okay.
They're just going to carry forward until you can use them. If you never use them, then they go unused. But
they just
but mostly if you're getting into these deals, at some point this apartment building is going to sell, and your losses will be brought forward to offset that gain. So.
All right, great. Okay, so Ka asks, if I am a real estate professional that has rental income and I fix and flip houses and wholesale deals, would I be able to write off the full amount of losses in box 2 of the K-1 that I receive?
You should be.
If investing in the syndication passively. So if he's investing in the syndication, and he's a real estate professional, he has rental income, fix and flip, and wholesale. Is he able to write off the full amount of losses in box 2?
No, because he's passive. You have to be active. You have to be a GP. You have to have a job in this partnership. If you're not active in the partnership, it doesn't turn that income into active just because you're a real estate professional. It still has to be active. Yeah.
Right. Of all the different streams of income that Ka mentioned, the rental income, that would probably be the only one that he could use the losses to offset against.
Yes,
not for the fix and flip in the wholesale.
Anything that will be passive, he could. Anything that's ordinary, like the fixing and flipping and wholesaling, no.
Right. Yep. All right. I think that's all the questions we have in the chat box. Yeah, I think that's it. Thank you. Thank you so much, Deborah. We really appreciate all your time today. I mean, we went really deep into the K-1, which is so helpful to me because I feel like I'm going to have a much better grasp when looking at it this year. So really appreciate it.
Right, and if you get the tax return, you'll be able to verify some of those numbers a lot better.
Exactly. I'm definitely going to verify,
Yeah.
recalculate and verify. Trust but verify is what we do.
Right.
That's auditors anyways. So
Right,
yeah,
exactly.
that'd be great knowing how to do exactly that. So really appreciate it so much. And thank you so much for everybody who attended the webinar today. And Deborah, just one last thing. How can people get in touch with you if they have questions or they want to inquire about your service?
Did you have my email up in the beginning?
You know what? I had a box for it. I can share my screen again. Let's see.
Yeah, I thought it was up there.
Yeah, I had put it up here. But
Yeah,
yeah, I'll share my
yeah.
screen. There it is again.
Yeah, that's how you can get a hold of me.
All right.
That's
MRM
right.
CPAs.
Yeah, .com. Yep.
Yes, I will include a link to your website actually in our replay email and on our YouTube channel as well, so other people can find it easily.
Okay.
All right. Well, thank you
Thanks for
very
having
much, everybody.
Okay.
Have a
Bye-bye.
great rest of
Bye.
the day. Bye-bye. Thank you.
Thanks, Deborah.
Thank you.
Bye. Bye.